Hello and welcome to Market Wrap, an initiative by ICICIdirect.com. And I have with me Mr. Pankaj Pandey, Head Research, ICICI Direct. Welcome, Pankaj.
Thank you, Gitu. Good afternoon.
Very good afternoon. Market remained extremely volatile during this week, and it was the last monthly expiry for FY21. And index opened positive, but they failed to hold on to the gains. And Friday session, remained a little good and gave some positivity back to the market. So, how do you explain? I mean, what is really happening in the market, and what is bothering the markets?
So largely, if you look at whether it is domestic market or whether it is global markets, largely this week markets have been a bit choppy. Largely again a function of higher crude oil prices, which was at the initial part of the week, and the 10-year yields in the US continue to be higher. So which again is sort of pressurizing the valuation for technology stocks, and that weakness is also sort of resonating in our markets as well. And largely, what we have seen is that all your bellwether stocks look tired, so which is where we are sort of seeing a bit of a choppiness in the market. And as a result of that, Nifty sort of declined 1.5%. Broader market weakness was even larger. So small cap declined nearly 3%, although mid cap did slightly better. But I think good part of all this is that despite higher COVID cases, the markets have been absorbing all this negative news without much of a dent overall. Because what we have seen is that typically on a weekly basis, since March 2020, we have seen that markets not correcting more than 9%. We have corrected about 7.5%. But what we have seen is that there is a buying which you see which comes at the lower levels. And I think same thing has happened this week as well. So buying has come in at lower levels. So obviously, there is a lot of buyer interest at lower levels, which is a good thing from a market perspective. And I think largely structurally, one should be biased if the budget day lows of say 13,600, I think are upheld. I think since next week, you've got only 3 trading days because of it's a sort of a truncated week. So largely expectation would be that the markets would remain in a sort of a tight range of say 14,400 to 14,800 kind of a range. But then again, I think like we have been saying earlier also in a choppy market like this, the defensives relatively do better. I think pharma price-wise, time-wise correction largely looks done. I think we have seen some bit of a bounce back in some of the key names like say DV's Laboratories or for that matter Cipla. Similarly, I think what we would expect probably going forward is that since crude has sort of declined a bit, so I think paint companies could benefit from that aspect. So within FMCG, those look good. So IT, pharma, FMCG looks good. I think metal continues to be a surprise pack. So despite witnessing one of the best rallies, since the prices are at elevated levels and with the kind of a stimulus which is planned in US for infrastructure spending, I think commodity prices could remain at elevated levels, and which is why steel has benefited. Structurally, we have been sort of looking cement more positively. Cement also has done well, largely because it's a low volatile commodity. But our sense is that probably markets could remain in a range for some period of time. But stocks where we have seen a correction, I think largely are not witnessing further weakness. So I think that is a good news. So market is absorbing all the good news. So I think the bottom line is that at lower levels, you see buying in buyer interest coming in, so which is good for the markets. I think for markets to make new highs or new, I think we need some bit more of a positive news. Next week being a sort of a truncated week, not expected to happen. Subsequent to that, I think we'll have to look at what is the kind of quarterly numbers we can expect. I think that could help the market in gaining some direction. So I think so that is how it is for the markets for the next 1 week.
Now that metals are strongly holding up, are you changing your view on the metals because you were a little out of the metal stocks? So would you be buying a few of the metal stocks which you look good to you at these current levels?
So I think largely we'll have to look. Our cautiousness from the metal pack is coming from 2 or 3 perspectives. One is obviously that largely bulk of the growth is driven by China, and China has given a 6% GDP kind of a target. But now, in case if US plans a big sort of a stimulus, especially on infrastructure building, which is what they are talking about, then I think probably we'll have to reconsider our stance, because that might give a good amount of push to metals as overall prices. The other thing is that, see, in metals domestically, what has happened is that if the kind of infra push, the volume growth looks more certain from that perspective. I think raw material prices or finished good prices will keep on fluctuating. So probably we'll have to sort of live with that. But I think it's we'll have to probably look at seriously considering whether to sort of maintain that cautious stance or turn bullish on that pack. But I think not to say that cement does not look bad. So cement is still the sector we would be more comfortable recommending with.
Pharma, you just spoke about. Supply is up nearly 4% this week. Dr. Reddy's is up nearly 3% this week. And you have a few buys in the mid-cap space too. So what should one do in pharma? Really get into these stocks at these levels? I mean, if somebody really wants to get exposure to pharma space?
Absolutely. I think pharma as a space hasn't really done well in the last 4-5 years. I mean, I think the only segment which did well in the pharma was the MNC space, because you treat these MNC companies with which deliver about 8 to 9% kind of a growth with elevated or good margins, good ROCs, as a pseudo FMCG kind of a stocks. So that is where the growth is expected to come back, and something like Abbott looks quite structurally positive besides Sanofi. But I think the US market and the CRAMS as an opportunity looks quite attractive. So whether it is Divi's Laboratories, whether it is Syngene, or whether it is Florus Labs, I think these are structural buys. I think when the US market recovers, probably the likes of Sun Pharma or Dr. Reddy, I think should perform. So overall, most of the companies are looking good. I think structurally, it is the domestic MNCs which look good, or the CRAMS players. But overall, I think pricing wise, we have seen decent amount of correction, and time wise also we have seen decent amount of correction in the pharma as an entire pack. And if the markets are choppy, I think this is a sort of a good place to hide into. So I think that way pharma looks positive from that perspective.
Now that earnings season is coming by, I mean it's just a week away. Which of the sectors would you prefer based on the earnings? I mean, if you are to rank a few sectors on 1, 2, 3 basis, which are the top 3 sectors that you will look forward to in this earnings season to perform better?
So I think from the earnings perspective, if you look at IT and pharma are the 2 sectors where we had seen the least amount of disruption or damage in terms of earnings. Now, say, for example, for IT, overall expectation is that you will get a dollar revenue growth of 2 to 4%, despite this is a sort of a weakish quarter. But since the companies had witnessed a decent deal wins, we would expect ramp up in or execution of those to sort of come into play. So from that perspective, IT is expected to come out with a good set of numbers. I think where there is some bit of a good problem for IT is that the margin could get weakened, largely because if you look at companies are now, so TCS is now coming with a second round of a price hike for players. HCL is expected to come out with weakest set of margins, largely because there is a salary hike and one-time bonus what they have given. But I think these are good problems to have. So IT is expected to come out with a good set of numbers. I think same is the case with pharma. I think some of the smaller segments like tiles and all that, we are expecting good set of numbers. So something like Kajaria has guided for double-digit kind of a growth for the next 2-3 years. Because largely a lot of unorganized players have started exporting to US, and which is why the domestic market has become better in terms of pricing and volume growth. Otherwise, I think largely even FMCG as a pack is expected to deliver good set of numbers, especially the paint as a category.
Anything that you want to say on the oil and gas sector? It has been very volatile. I mean, there has not been an active participation in the oil and gas space. I mean, it's down 4% this week. With crude near $70 per barrel, what should one do in oil and gas space? I mean, stay away clearly?
So I think in oil and gas, so there are 2 variables to sort of look at. One is if there is a volume growth which is going to happen. So volume growth is not a case. Largely, if you look at whether it is upstream or downstream, there's hardly been any volume growth. The other thing is then you look at realization, which again keeps on fluctuating. So which is again a sort of a challenge. So I think gas is the only space which looks relatively attractive. So Adani Gas or MGL, IGL or Gujarat Gas, I think these are the kind of place one can look at because, say for example, Adani Gas is the only sort of pan-India player which is expecting or which is looking to have a pan-India footprint. And mind you, if in the energy mix, gas is expected to increase from 7 to say 14, 15 odd percent. And I think these are the companies which are likely to benefit more. I think downstream, upstream, the life is going to be a lot more challenging, though they are trading at cheaper multiples of 6 to 7 times. But the basic question is whether 5 years, 7 years down the line, you would buy an electric car or IC powered car or SUV. So that is where I think the big question lies. And which is why I think if you can't really sort of think for that long term, I think it is better to sort of stay away from that back.
PSU index got a good beating this time. It's down nearly 4.5%. In this kind of a crash in the PSU stocks, would you be a buyer in a few?
So I think in PSUs, we have seen a good amount of cracks, especially in banking overall, because they've been sort of performing or they've performed one of the best. But there are certain pockets in PSU banks, in PSUs, which can be looked at. So, for example, we like the logistic player like Concor. Our sense is that the kind of efficiency what they can sort of come up with is fairly large. I mean, you need a good manager to sort of run that company. Because a private player like GDIL gets a revenue double in terms of per container. The EBITDA margin is 3 times more. So you need an efficient player. So something like that is looking very attractive. I think the entire defense PSUs look attractive, whether it is Cochin Shipyard, because they are sort of building up a ship repair facility, which is a more sort of a structural positive. It's a sort of a regular revenues which you earn and with good margins. Then I think the other defense PSUs like Midhani look quite attractive. So I think these are the kind of names within the defense which look attractive. Besides, I forgot to mention Bharat Electronics, which again is a sort of a key defense PSU. So I think these are the kind of names which we like within defense as a space.
Pankaj, what will you do in banking space? The banking index is down to nearly 33,000 levels. We were expecting it to be near 45 and 40, but now it's back to 32,000 levels. What should one do?
So I think in banking, largely, I think at this point in time, probably the concern is that there could be some bit of a one-off you will get in terms of higher provisioning, what banks will have to do, because now the Supreme Court has cleared the way for recognition of asset quality. But I think our sense is that largely that has been sort of provided for. So that way, even in Q4, you would expect elevated levels of provisioning to remain. So we are not expecting any sort of further damage to book. Plus, I think if there is a further sort of a restriction because of COVID, I don't think it is going to hamper the way it sort of hampered last year. So banking, since it has sort of performed, we are seeing more of a price correction and time correction, and some bit of more and price time correction can happen. But I think all your tier one banks look attractive. I think if you look at the resolution of also stress cases is happening. I think Bhushan Power, we are sort of doing it. So I think SBI is expected to be a biggest beneficiary. And largely all this particular account was 100% provided for. So SBI is going to get a nearly 4,000 crore, whether they show it in the bottom line or increase the provision or maintain for provision. It's a choice to them. We would expect to sort of maintain a higher provision. But that way, I think banking, since we are not seeing any stress cases, most of the corporate books are now sort of quite leaner. So that way, I don't think you have much of a structural issue with the banks. It's just a matter of time which sector performs. I think classically it is a sector rotation which is sort of panning out more. And in result season, you will see more of a stock rotation which will happen.
In the financial space, if you're given an option between a pure bank, NBFC, and an insurance company, which segment would you be a buyer in?
So, for example, I think if I have to add one more segment, so say, for example, we would like something like SBI cards or something like CAMS, which again is not a sort of a typical AMC, but is a good play on the overall higher allocation towards equity or debt. So CAMS looks quite attractive to us. They've got nearly 70-75% kind of a market share. SBI card looks quite attractive to us. I think the scare of higher asset quality concerns is already behind us for SBI cards. Similarly, we like exchanges like MCX. So I think these are the names. I think banks, again, top three private banks, or I think something like Kotak, HDFC Bank look good. I think besides that, life insurance looks good, and you have only HDFC Life and SBI Life to look at.
So financial you in all, I mean.
Yep.
You're picking up few from every segment, right?
Yes, but see, it depends on the kind of risk appetite one would have. If one is not looking at the volatility the way you get in banks, because every cycle you'll have asset quality problems. But if you're not looking at that, then if you want to ignore that, then I think life insurance and something like SBI cards, or say, for example, CAMS kind of, or MCX kind of a business is what one should be chasing.
Auto segment, would you be clearly staying away from this for some time?
Absolutely. I think auto, the commodity prices have been inching up while key players have been taking price hikes. That is understandable. So margins are expected to remain under pressure. I think the other challenge is that chip shortage is sort of is coming at the forefront because I think 2 days back there was a fire at one of the Japanese manufacturers' plant, and that could have some impact in terms of chip supply. I think a lot of players are not able to ramp up largely because there is a shortage of chip. Besides that, I think there is structural concern in terms of underinvestment in technology and all that. So I think auto is expected to remain under pressure. So I think chasing auto is a bit difficult, or we have not been recommending at least leading OEMs in the auto space.
Top 3 picks for Holi, colorful.
So I think I mentioned some of the names. So for example, on the consumer side, you could have Asian Paints, Dabur, Titan looks good. I think SBI cards, CAMS look good. Infrastructure, I think, or logistics, Gateway District Park with a target price of 240. Then Concord looks good. I think in IT, TCS looks good. Besides that, I think you have other names like, say, for example, Birlasoft, which looks good. And Matrimony is something which we like as a business also.
I asked for 3, you gave me a bunch of them.
I gave 3 in each of them.
What should one expect in the markets next week, Pankaj?
So a shorter range, so 14,400 to 14,800, largely because you have got only 3 trading days. But I think the kind of bounce what we have seen in mid caps and small caps, I think that can sort of be there for the next 2-3 days. So that way, broader market looks good. Nifty, I think, should be in a sort of a range. And you really do not have much of economic activity or data to sort of come out. So which is why I think triggers for both downside and upside are sort of limited.
Technically, we say, is it a dead cat bounce or is it a bounce to stay?
So I think the way markets have been absorbing negative news, definitely there is a case for buying at lower levels because you see that strength at lower levels. So it's definitely not a dead cat bounce because we have not seen a big crack in the market. So I think it's a structurally positive market. It's just that it is sort of spending or looking a bit tired from a shorter term perspective. But that is not to say that you're seeing weakness at every level. So at lower levels, there is definitely some bit of a buying which is coming up and which is quite good. And ideally should have cycles of correction and rally to make the market more healthier. So I think one should not really take this into a negative stride.
So it's still a buyer's market. It's an
absolutely. Absolutely.
Thank you, Pankaj, for being with us, for your time. Thank you very much.
Thank you, Peter.